Greg's Thowless-Reeves.
And I'm Richard Farmiloe.
And we're here to talk about markets. We like to do these vlogs on occasion, but you should be aware this is a little scruffy, this is unedited, unrehearsed, but we wanted to talk about what have been some fairly extraordinary market conditions over the last couple of weeks. In terms of the facts, let's just talk about those. We've seen from peak the UK stock market fall by about 30%. We've seen similar falls in oil and industrial commodities. And on the flip side of that, we've seen rises in defensive assets such as gold, and if you look at sovereign debt or gilts. And the rises in those have been quite extreme. At one point, we had UK debt with a negative yield, which is the first time that's ever happened. Other countries have had that. We've seen that in Switzerland, we've seen it in Japan. German bunds have been doing that for the last few years since the financial crisis.
I'll just interrupt. I mean, what essentially that means is that if you hold those bonds to repayment, you're guaranteed to make a loss.
Yeah. And our view with that is that the second a sovereign debt, or indeed any debt, has a negative yield, then buying it or owning it, it ceases to be an investment. Because fundamentally, if you hold that to maturity, you're going to lose money. The only way you can make money is if someone comes along and pays more than you did, which is known as a greater fool theory.
But that's exactly what's driving the price of bonds. They think that the governments are going to buy them back at a higher price, so even if they buy them, traders buy them with a negative yield, they think that the central banks will come along and take it off their hands at a higher price. Yeah.
So we know that's the outline what has happened, and then there's a fairly obvious answer, not question to why, which is we've got coronavirus there. Now, coronavirus is taken hold of people's imaginations and health systems with alacrity. But I mean, just to sort of position ourselves here, I mean, we read a lot, we follow the news, we look at the analysis, but we're not trying to present ourselves as experts on coronavirus. But the purpose of today's vlog is because what we are pretty good at doing is interpreting how markets are likely to respond to this sort of uncertainty, because we've seen this before and we've invested and guided clients through these markets before. And so that's really what we wanted to talk about today. Not really what's going to happen with coronavirus, because there's a huge amount of uncertainty and it remains a very dynamic situation, but why markets have responded the way they do and what they're likely to do in the future, because that's kind of the million-dollar question. So one of the things that we were discussing yesterday when the market was down 10% is this starts
10%
to feel...
in one day.
I know.
It's quite staggering. We say it as a matter of fact, but it's actually quite a staggering statistic. Yeah.
And that's bigger than any day in the financial crisis. The last time that happened was in 1987.
And actually that was just after I started my career in finance, which gives you an idea of how old I am. But
yes, and also that you're probably cursed. So let's bear that in mind. But so a 10% fall, biggest since 1987. It triggered the limits on the US stock markets.
Circuit breakers, which is designed to give people time to pause and for prices to become a bit more, not rational I won't say, but time for all the trades to go through and to sort of reset. So
why have stock markets fallen?
Well, firstly, I didn't foresee, and neither did you, I guess, neither did anyone see not so much the virus, but the impact it would have on markets. Yeah. We knew that it would have an impact, but I think the impact has been exaggerated by a few factors that maybe weren't around in some of the other bear markets that we've seen before. It's constantly on the news, it's constantly on media, social media, through tablets, you have iPhones, the news, 24-hour news programs. We didn't have those sort of 15 years ago. And
the smartphones, ubiquity of getting that information. Exactly. It's in your face.
And also trades in the markets. I mean, if you went back to when we started our careers, trades in the market were initiated by human beings, at the other end.
Can we come on to that later?
Yeah, I will do, but the point out, we can talk about how that's changed things. Yeah. But nowadays, they reckon that almost 9 out of 10 trades are done by computers, and a lot of those work on computer programs that pick out certain words or phrases or texts, algorithmic trading as it's called. And so that, I think that's the reason behind. I mean, we call this a bear market because it's now down more than 20% from peak to trough, but normally bear markets used to be a slow grind down. It's very rare, apart from 87, where you had one day when it happened.
It was 16 days and we've lost
30%. Exactly. And I think that's the reason behind.
So the pace is a different sort of question. The reason why is because there are threats to economies. There are threats to
essentially, it looks like most of the Western, the global economies are going to almost grind to a halt for maybe weeks and possibly months.
And there are certain companies, certain sectors which are clearly in the firing line. So I mean, you wouldn't want to be owning a cruise liner. Airline companies.
Well, you might now.
Okay. But airline companies.
The price is down sort of 60 or 70%.
Have enormous latent risks in their business model, which are revealed by how they react to these sorts of things. So we've also had some contributing factors, so not just coronavirus. So you've had the oil price falling, partially as a response to that slowdown in the economy, but also because of the fallout between Mohammed bin Salman and Putin.
There's a price war broken out. I mean, essentially, we can cover all, but essentially, I mean, the Saudis said, well, Russia didn't want to agree to production cuts, but the also the thinking behind this is both Putin and also Putin has decided that now is the right time to try and get rid of the shale industry in the US, which operates. Which is only profitable at much higher prices. In fact, it's not really profitable at all. The shale business has been going for more than a decade, and yet the losses are in the tens. Yeah,
to be fair, the resource has never been exactly fond of capital discipline, as we call it. So the oil industry, mining companies are prone to being very poor for judges of when to invest their capital.
The shale industry is a particular instance because it's cost billions, hundreds of billions to actually drill shale where they split rocks open to access the oil. And they've gone into bankruptcy. The whole industry has almost been into bankruptcy a couple of times. And now this is the third time, or at least that's what Vladimir Putin, I think, is gambling on. If he's successful, then the oil price will soon go back up to sort of $60 or $70. And the US will lose its oil independence to some degree. So
well, I mean, I have a slightly different view. I mean, you're right about that, but I think that there's fundamentally an infinite amount of oil available from shale at $60. So as long as they can keep it below that, they will drive out investment into there. But again, the oil price.
You could have said that. You could have said that 5, 6, 7 years ago.
Well, it's still the case. We kind of were saying that, but we can't prohibit.
But I think
pumping money into something which is loss making.
I think the banks and the people who were financing the industry will probably, this will be the straw that breaks the camel's back. I mean, maybe they'll get fooled once or twice, but a third time round.
I agree. It seems unlikely. So
but it's a gamble by essentially.
But there's another factor we're saying. We're adding that into the mix to coronavirus. There's also, just bubbling under the surface a little bit, you can see the sterling has been weak against the euro, but it's been relatively strong against the dollar, suggesting that Brexit and uncertainty there has also played a little part.
We're sort of getting away from the point. The main point we're here to discuss is, the speed and severity of the downturn due to the coronavirus, because that's the main, has been much greater than anyone or most people could have foreseen.
Yes.
I guess the question is now, where do markets go? Where are we in that stage of a bear market? How long do we think it'll last? And what will be the catalyst for us to come out of that?
So we've been talking about capitulation. Now it's a term which perhaps we're more familiar with than other people. So how would you describe what capitulation means?
Well, I suppose capitulation means, I suppose you'd have to look it up in the dictionary. It's almost like giving up. It's the final phase of selling where people just completely throw in the towel, as it were. And to me, 10% the other day, that felt like capitulation.
Now, the important bit for trying to identify capitulation is what?
Well, capitulation is often people who just give up, throw in the towel, and also forced sellers. I mean, people who are operating on borrowed money, at some point they get a margin call. I mean, it's not so prevalent in the UK, although we can come on to that, but much more prevalent in the US and other areas where they can borrow against portfolios. I mean, hedge funds, what is a hedge fund? It's a leveraged fund, so it uses debt. And once prices get to a certain level, they become forced sellers. The people they owe money to say, you've got to sell this to cover your losses.
So when you see or sense capitulation, it's a strong signal that you're close to the bottom, in that you've flushed out most of the people that are going to be either willing sellers or panic sellers or forced sellers.
I mean, a bear market ends when there's no more sellers. It's precisely when a bull market ends is when everyone's bought and there are no more buyers.
Now, okay, so if we think that we've shaken out a lot of those panic sellers in the absence of worse news, we are where we are. Now, coronavirus is going to get worse in terms of the number of people infected, the number of deaths, but stock markets are forward indicators. So the question isn't, is coronavirus going to get worse? It's how much of that has already been encapsulated in the price of equities today. Now, that is unknowable, but to our view, they've encapsulated a very, very bearish situation. Now, coronavirus is unlikely to be permanent. We say that not because we have any sort of great depth of biology, but simply because flus have existed for thousands of years and they've never metastasized into a permanent situation. That's just not how they work. So one can have a very high degree of certainty that we will get over this, and there will be another one in due course.
It just depends.
But COVID-19 will have a finite life, and so it's unlikely to have a permanent diminution of the global economy. But the point is, we're going to go through this. We're going to go into a recession now, and if it seems likely, we're likely to have a V-shaped recession. So steep in, but then also steep out later.
Yeah, you're right. I mean, the reporting about the number of cases and the number of deaths will continue to go on, and it will continue to rise. But at some point during that process, the market or investors become, inured to further news. I mean, if you take an example, it's like the trade wars with China. At first, when the trade wars, the tariffs were announced, the markets were roiled, and it went on and on about whether was there going to be an agreement or not. And eventually, an agreement took, I guess, almost 2 years. But by that time, the markets were so used to that news. In fact, quite a long time before the actual deal, that the news of a trade deal or hiccups or barriers didn't really affect the market to a great degree, because investors started to look through that to the other side. And at some point it will be the same with coronavirus. At some point, markets will start to look through to the other side, and what's the landscape going to look like when the coronavirus dissipates?
And look at the valuations of the
companies. And that won't be when, if people say, well, what about when the news starts to get better, when the number of new cases starts to plateau or fall? Well, by that time, the market will be X amount higher, but quite substantially higher than it was. Markets don't wait for the news to come through, they try and anticipate it, as you said, they're forward-looking mechanisms.
So we have this slightly sort of strange situation when actually, if you want to try to take advantage of some of the prices that are available now, you're buying it before the worst of the news.
You have to. That's always the case. You can't wait for the news to get better. You have to take a leap of faith sometimes.
And certainly our view is that there is sufficient opportunities available in price of equities now that we think it is a better use for people's assets to be investing in those equities. They're just too cheap.
I would also say that the government's responses around the world to this is a little different than previously. Over the last, a decade, we've become used to central bankers cutting interest rates, providing liquidity to markets to make sure that markets function smoothly. Well, they have done that, but also differently in this case. Governments are starting to announce fiscal policies. So, in other words, government spending, which hasn't been the case before. So, if you look at the UK and the budget, there was I think a 30 billion, 30 billion of infrastructure spending on roads, buildings, housing, etc. The Americans are going to be announcing the same, I think, and so are the Europeans. So this time you've actually got government spending as well. So this is why we believe that when the recovery comes, it's going to be I know it's a hackneyed phrase, but a V-shaped recovery, because there's so much stimulus and spending on the other side of the coronavirus, that as soon as we get past the worst economic effects of the slowdown, the global slowdown or halt in the global economy, at the other side there's going to be a huge increase in spending, which means jobs, extra income for people, and consumer spending, all the drivers of a stronger economy. Which is what many people have been waiting for years. Many commentators have said that you don't just need central bankers cutting interest rates, you actually need governments to start, stimulating growth as well with their policies. And this is, whether you view it, wherever your views on coronavirus, this has actually been the
well, certainly going to see if that'll work, because you're right. It's not going to be much. It is going to be fiscal, and that's going to be widespread.
So I think we're going to go from a very sharp slowdown to a very significant, increase in economic activity.
So while we think that there's one should caveat that slightly in that we think there's going to be volatile still. It's not going to go from here in a nice smooth path up. There's a lot of green on the screen today. The market was up 4%. It was up 8% earlier. There's a huge amount of volatility left in as market absorbs the news of coronavirus. But we're looking beyond the next sort of day or week or month. We're taking a view that there's a fundamental value to be had in owning these companies. And at the moment, because of the panic in markets, the companies are being undervalued for their long-term potential.
I mean, panic is a good word. I know it's a strange thing why our stock markets are volatile and more volatile than other assets. It's purely because when people panic or are scared, they sell what they can immediately sell. And if you're in other asset classes like property, it takes a while to sell a property. With the equity markets, you can sell almost virtually straight away. And so people liquidate what they can liquidate, and that's essentially why stock markets are more volatile than other asset classes. But to compensate for that, you get better returns.
Yeah.
And we're not only equity-only investors for clients. We invest in a wide variety of assets depending on what the client needs. But if you're talking about bonds, we think sovereign bonds are, to us, uninvestable at negative yields. Corporate bonds, we've been very selective and careful on because the corporate world has got a lot of increased debt.
And there was an insufficient premium. You got an insufficient extra return for taking on that additional risk.
But it may be that this kind of event, corporate bonds are beginning to...
It'll normalise the prices, they'll come back on the table.
Exactly, so that's something. Gold, we're not gold bugs, we have got some gold.
We did have a significant portion of gold for our clients as a hedge against bad stuff happening, and it's proved to be very helpful for us.
I mean, I suppose, I always remember reading a statistic about gold, that gold loses value about 80% of the time. In other words, when it makes money, it comes in very short, sharp bursts of price appreciation. And often the time to own something is when no one else wants to own it, or when Gordon Brown's selling it.
Yes, well,
which back in 2000 or 2001. But yeah, so once, if we're right and there is a recovery in the global economy, then I would struggle to see gold making a lot more headway. But that's,
I agree. So we would expect for volatility to remain in the short term, for the falls in equities that we've seen to reverse. We're not going to get back up to where they were, but where we are today seems unsustainably low.
Well, when you say we're not going to go back up to what we were, you don't think so?
Well, so the FTSE 100 7.6. I don't think we're going to see that again in 2020.
I don't know. I mean, markets can... I think, again, a lot of people... We did an article and I mentioned that a lot of investment advisors in America had never actually seen a bear market.
Yeah.
So this is all new territory to them and they can understand why it scared them. I mean, this is the fourth bear market I've seen. So I'm not saying it's a pleasant experience, but you become a bit more, you don't panic quite as much as people who have never seen one.
Yeah.
But it used to be common that you never, in a year, you always got at least a correction of 10% or more. It's only that because investors in recent years have got used to such low volatility due to central bank support, where you didn't get movements of more than 1 or 2%. This, not so much the events of the last couple of weeks, but movements, of up 5% or down 10% during a year, were commonplace. That was part and parcel of equity investing. Yeah. So I think that is back, but also, look at, you talk about 87 when the US market dropped 20% in one day.
Yeah.
Well, by the year end, it finished the year higher than it was. So I don't necessarily subscribe to your view that we won't see 7,600.
I'll bet you a shiny 10pence on that one.
I'll bet you a pound.
But I also don't. I don't think we're going to see. I'm going to see the lows that we've seen again. I cannot see that enduring.
As I say, one can never say for sure. I mean, but to me, that felt like capitulation, the final stage. And it's been a bear market, but it's been a damn quick one.
Yeah.
But coronavirus, as you said, it's all about the effects. And if we're right and we get a very strong economic recovery, then yes, I don't see any reason why the markets can't return to where they are. Shall we have that, Pat?
Okay, so we just want to bring that to place. So it's much easier for us to articulate our views when we have a sort of conversation face to face with the camera and distribute that. So we're going to try and get this out as soon as we can, so you get that. If you have any sort of questions, you know how to sort of contact us. But I hope that's been sort of useful for you to hear how we are thinking and how we invest. But thank you for your time and your attention.
Thank you.